Have you ever stared at a company's financial report and just felt completely lost? Like you're trying to read a language you've never seen before? Well, today we are pulling back the curtain and decoding the secret grammar of business. We're talking about the universal rules that turn a sea of numbers into a story you can actually understand, trust, and most importantly, act on.
Huh. There are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
So let's get things off with a thought experiment. Imagine you're an investor, right? You're looking at two companies, Company A and Company B. They're in the exact same business, sell the exact same stuff. But when you get their financial reports, they look like they're from different planets. How on earth are you supposed to compare them? How do you figure out who's actually doing better? You see, without a common set of rules, this isn't just a tricky puzzle, it's a massive problem that would make global business pretty much impossible. And that's exactly where this master rulebook comes in. To cut through all that chaos, we have what's essentially a universal grammar for business. It's officially called the Conceptual Framework for Financial Reporting, and it's the bedrock that allows everyone, whether you're in Tokyo or Toronto, to speak the same financial language.
Okay, let's dive in. Here's what we're going to cover. We'll start with why we even need a universal business language. Then we'll get to the main goal of all this reporting. After that, we'll look at what makes financial info actually useful, get into the core rules of accounting, tackle the big question of how we measure value, and then wrap it all up with why this framework really matters to you. So first up, why a universal language? You should think of this framework not as some old, dusty rule book sitting on a shelf, but as a living, breathing guide. It tells companies what information to report, how to put a number on it, and when to share it. It's the reason that when a company in Germany reports a profit, it means the very same thing as a company in South Africa.
Now, the group behind this whole global standard is the International Accounting Standards Board, or the ISAB. Their set of rules, known as IFRS, are really the dominant player on the world stage. You can see here that over 90% of countries have adopted them for their public companies. This creates one unified system which makes it way easier for investments to flow across borders. The one big holdout, of course, is the United States. They have their own system, but even they accept IFRS reports from foreign companies that are listed on their stock exchanges.
So now that we have this global standard, what's it all for? What is the ultimate why behind all these dense rules and regulations? Well, it turns out this entire incredibly complex framework is built around one single, clear objective. And here it is, the heart of the matter. The single most important goal is to provide financial information that is useful for making decisions. And who are we trying to help here? Well, the main users are investors, lenders, and other creditors. Basically, anyone with money on the line. They're trying to answer really important questions like, should I buy stock in this company, or is it safe to lend them money? This entire framework is designed from the ground up to help them make better, more informed choices.
Okay, but for information to actually be useful, you can't just throw a bunch of numbers on a page and call it a day. It has to meet certain quality standards. I kind of like to think of these as the good sportsmanship rules of the game. They make sure everyone's playing fair and the final score is trustworthy. The framework breaks these qualities down into two main buckets. First, you've got the fundamental qualities. These are the absolute, non-negotiable must-haves. If the information doesn't have these, it's pretty much useless. Then you have the enhancing qualities. Think of these as the boosters, the things that take good information and make it great. The first fundamental quality is relevance. And the question here is really simple. Does this piece of information actually matter? Could it change the decision you're about to make? Information is relevant if it helps you predict what might happen in the future. That's its predictive value. Or if it helps you look back and confirm if you were right or wrong about your past predictions. That's its confirmatory value. Now, a huge part of relevance is this idea of materiality. Information is considered material if leaving it out or getting it wrong could realistically sway a user's decision. And what's really interesting here is that it's not just about how big the number is. I mean, sure, a $50 million error is obviously material. But think about this. What if a company executive paid a tiny bribe, say just a few $1,000s? The amount is small, but the fact that it's an illegal, unethical act makes it highly material information for an investor. All right. The second fundamental quality is faithful representation. This basically means the numbers in the report have to paint a true and honest picture of what actually happened. For that to be the case, the information has to be complete, nothing important can't be left out, it has to be neutral, not spun to make the company look better than it is, and it has to be free from major errors. A key idea here is substance over form. For instance, let's say a company sells a building but has a secret side deal to buy it right back next month. Legally, it's a sale, but is that the economic reality? No way.
The substance of that deal is a loan, and that's how it has to be reported. So now for those 4 enhancing qualities that make good information even better. First, there's comparability, which lets you see how a company stacks up against its rivals, or even against itself from last year. Then you have verifiability, which means different smart people could look at the data and all agree on what it means. Timeliness is a big one. Old news isn't very useful, so you need the information before it's too late to act on it. And finally, understandability. The report has to be presented clearly so that someone with a decent understanding of business can actually figure out what's going on. Okay, so holding all of that up are a couple of rock-solid assumptions that the whole system of accounting is built on. Let's dig into that groundwork. Now, this next one is probably one of the most important ideas in all of accounting, the accrual basis. All it means is that you record things when they actually happen, not just when the cash moves. And this is absolutely crucial because without it, companies could easily cook the books. For example, a business couldn't just hold off on paying all its bills until the new year just to make last year's profit look amazing. And here's a perfect real-world example. Let's take a retailer like Aritzia. In February, they use a ton of electricity to keep the lights on in their stores. Under accrual accounting, they have to record that electricity as a February expense because that's when they got the benefit. It doesn't matter one bit that they probably won't actually pay the utility bill until sometime in March. The economic event happened in February, so the expense belongs in February. Simple as that.
The other foundational rule is the going concern assumption. This is the default belief that a company is going to stay in business for the foreseeable future. We don't pick up a financial report assuming the company is about to go belly up and sell off all its assets next Tuesday. And this simple assumption has huge consequences. It's the reason it makes sense for a company to own things like factories and machinery, these long-term assets, because we assume they'll be around long enough to actually use them. Okay, so the accrual rule tells us when to record things. But that leads us right into another massive question. How much are these things actually worth? How do we put a precise dollar value on all the stuff a company owns and owes? This lands us in the middle of a major debate in the accounting world, and it really boils down to 2 different ways of thinking. On one hand, you have historical cost. It's straightforward. You just record an asset for whatever you paid for it originally. Done. On the other hand, you have fair value, which asks, what could you sell this asset for in the market right now? So let's say a company bought land for $1 million a decade ago. Its historical cost is still $1 million. But if today that same piece of land is worth $5 million, well, its fair value is $5 million. And this really gets to the heart of a classic tug of war in accounting. That $1 million historical cost is super reliable. You can verify it, you have the receipt, it's a textbook case of faithful representation. But is it all that relevant to an investor trying to make a decision today? Probably not. The $5 million fair value, though, is extremely relevant, but it can be less reliable because a lot of the time it's just an estimate. So you can see the dilemma. Rulemakers are in a constant balancing act between these 2 qualities. So we've gone through a lot of theory here. Let's bring it all back home. Why does any of this stuff actually matter to you? Whether you're an investor, a student, or just someone who's curious about how the business world really works. Look, here's the bottom line. This framework is what gives financial reports their real power. It builds trust by demanding that the numbers reflect reality. It creates comparability so we can actually make fair apples-to-apples comparisons. It gives us predictive power by focusing on relevant information and the true timing of events. And when you put it all together, it gives investors and lenders the confidence they need to put their money to work, which is what fuels the entire global economy. It's what transforms a financial report from what could be a biased sales pitch into a truly powerful tool for making decisions. And that leaves us with one last big question to think about. For 100 years, this rulebook has focused almost exclusively on one thing, financial value. But today, the world is changing. Investors and society as a whole are demanding more. They want to know about a company's environmental footprint, its social impact, how it treats its people. So the great challenge ahead is this. How does this universal rulebook evolve to capture and report on a much broader, more complete definition of value? That's the question that's going to shape the future of business.